Hey, and we're live. Welcome to today's special live stream, a market update to help you make sense of this wild and volatile market. If you don't know me, I'm Michael Obucina, head of education here at Robinhood, affectionately called Obi, joined by Steph Guild, our chief investment officer. Steph, we're back in the saddle. We've been here before. We're
Nice to see you.
Yes. To all of our old friends in the chat, we're seeing a few familiar names. It's great to be back. We miss you. To a lot of the new viewers here, welcome. Glad you found us. If you didn't know, we used to do this every Friday. We had a live stream called The Week That Was. You can still see some of those old archives on our channel. We drew that show down to start working on some other projects. But amidst all of this craziness in the markets, Steph, you're like, oh, we got to get back on air.
We got to get back on and chat.
Yeah, and you know, if you're new to this again, like, we want to hear from you in the chat. We want you to tell us what's going on, what you guys are seeing. We're here to help you out. But today, here's what we're going to do. We're breaking down the current market environment. What does it mean for stocks moving forward? This has been a whipsaw of a market. We want to kind of get a pulse of what's going on. Later on, you might have seen him here at the top of the show. We'll be joined by a special guest, Bob Iaccino, who is an expert in the oil markets and futures market. He's going to talk oil with us, talk a little bit about gold and silver, which has also been a very, very volatile space over the last few months. And if you didn't recognize Bob, he was a guest of ours at Hood Summit last year in Las Vegas, did an amazing panel on futures trading. So we're happy to have him back. And of course, we'll be taking your questions throughout the show and at the end of the show. So if you aren't a subscriber yet, please subscribe to the channel so you can get those questions and comments into the chat. I see the chat is flowing. We got a lot of good people back. If Edsmond isn't, hey, I see a familiar name. Dan Minata, miss you too, my friend. Edsmond Archery. Edsmond's back.
Yay.
How you doing? Edsmond's our #1 fan. He's got that #1 badge and Quantum Queso dip. All the old timers are here, Steph.
Yep.
All right.
Should we jump in because the market?
Let's get to it. But before we do that, as always, some ground rules.
Oh yeah.
Today's content is provided for informational, educational purposes only, does not constitute tax or investment advice, and is not a recommendation for any security or strategy. All investments involve risk, including the possible loss of capital, so please consider your investment objectives and risks carefully before investing or trading. Remember, past performance does not guarantee future results. And last but certainly not least, this live stream is not an official customer support channel. So if you have questions about your account, please reach out to our support teams from within the app. They're ready and waiting to help you. They're literally on the other side of this wall. With that, Steph, as you mentioned, so much to get to. Let's jump right in. What's on your mind? We haven't been on air since November 14th. We nearly top-ticked the market when we drew down the week that was. And since then, it's been nothing but ugliness and volatility. What's on your mind? What are you seeing? What should the audience out there kind of keep top of mind for themselves?
Well, we've had quite a bit of volatility, particularly under the surface. And one thing that when I was looking at like just year to date, like sometimes, you know, you get so into the weeds on the names that are moving both up and down that you forget to take like a big step back and you look at the difference between like, let's just starting with like what growth stocks have done this year versus value stocks. The difference, I mean, right now it's like 11, 12%. And in favor of value stocks. Like that is the first time in like many years, I think, that we've had that. And that to me is, you know, it's showing you like, one, that growth stocks may have gotten a bit expensive. You have a lot of the Mag 7 that haven't been doing as well this year. And really a lot of the opportunity has been below the surface. And then obviously with the conflict starting, that has put a strain on commodities, and energy and commodities are a bigger part of the value side of the market than the growth side of the market. So I think that's like one thing to just kind of point out, like what the trend has been this year, especially versus the last few years. The second thing that I want to point out is like last week, I don't know, I think it was like a Monday, it was maybe around the 30th. That was a very painful day in the markets. And I thought this is probably a dip buying opportunity. Yesterday with the everything rally, X energy and software, that was probably maybe even taking like some profits in the commodity space if you had, you know, in the resourcing, in anything sort of resources. But, you know, I don't think all of this stuff is over. Like, I don't think just because we have a 2-week ceasefire that everything is done. I do think commodities is going to be ground zero for what happens ahead. And I think, we should just probably look at some of these charts just to like kind of go over it, because lack of commodity and lack of supply, I think, is going to be, a dominant theme. And I think the market can look through it, but I'm just not sure it's fully like taken it in either.
Yeah, let's just bring up the chart of the S&P futures. This is such an interesting sort of rounding top pattern that we saw from the lows off of, this is Liberation Day back in April. We saw the huge rally off the tariff. And, I'm just going to preview a little of my thoughts here, Steph. The Iran stuff has a feeling very much of like what we dealt with the tariffs, just on a much bigger, crazier scale, right? Where we had sort of the market worrying and reaching lows, and then a news announcement that sort of headline risk comes into the market, and we get a rally to the upside. But going over the technicals, just looking at the S&P futures, I mean, we were in a dead bearish pattern. I think we hit correction territory. We were below the 200-day moving average. So just so you guys know what's on my chart, I use 4 different moving averages when I'm trading. I have the 14, 30, and 50-day, kind of my shorter-term moving averages. And you can see, basically, every time the market was hitting about that 14-day moving average, the market was selling that along the way. We get below the 200-day, and then we get the news getting us back over the 200-day this week. And here we are kind of resting on top of the 50-day moving average. And if we go to the intraday look, Steph, going back to yesterday and this week when we got the big sort of market rally, here we are just sort of floating on top of what is the 50-day moving average.
Kind of sideways.
Sitting on 6,800. And we have more headline risk, right?
Yeah.
Where is the ceasefire really happening? What's going on over in the Middle East? Is there issues with Lebanon? Is the Strait of Hormuz open or is it not? So it feels to me like any headline can move this market 100 points either way.
I mean, that's certainly true below the surface too. Like if you look at any name, like it's violent moves up and down. And that's why I think this has been one of those markets where you would you want to stay vigil, or is that the right word? Agile.
Yeah. Agile. Yeah. You want to be nimble. You want to be nimble.
Yeah. And I think you want to, if something's up a lot, I think you want to trim your winners. I read some piece where someone was saying like it's not the kind of market where you want to buy your losers because they just tend to continue to go down. I think it depends on the name, but I definitely think it's one of those ones where you want to sort of like try to get to playing with house money, so to speak, right? Mm-hmm. Where you take a little bit of a profit if you're up a lot. And you can see it in that sideways action, but we should look a little bit more below the curve. Like I would love to see what that chart looks like on the Russell 1000 value. Can you pull up like an index like that?
Yeah, I mean, we can bring up, let's look at Russell. I had VIX up here real quick. I just wanted to point out, VIX has obviously been moving higher throughout this entire episode as the market started, kind of coming into a downtrend, and then we get the geopolitical risk. But we see a huge gap down off the news. So where we were trading at, sort of like a 25, 30 handle on the VIX, now we're trading at a 20 handle. And if you don't look at VIX, I look at it as, if you're looking at the weather app, the first thing you see is like, what's the temperature out? It's kind of what I use VIX for, right? A 20 VIX, that's implying roughly about a 1.25% daily move on the S&P. A 30 VIX or a 32 VIX, which we saw, kind of like before the news came out about the ceasefire, you're getting closer to 2% daily move. So if you're a zero DTE trader, you're a short-term scalper, and you want to get a sense of what is the probabilistic levels that the market can reach today, you want to look at VIX, especially if you're trading something like S&P futures. If we go to the Russell, let's look at small caps. Here's one. We got some old drawings on here from back in the day. Here's one, a much different pattern, right? This is a grinding higher pattern.
Resistance, the peak is the new resistance, which I think is important. I think it's super interesting on the small cap side to say that, because it's very economically cyclical. Sensitive to cyclicals. So, if the view is that like we're going to get through this, then small caps is definitely a place to consider.
Yeah, one other chart I want to add to the mix, Steph. This is a new one. If you remember back at Hood Summit, SIBO announced a new index called the MAG 10 index. We just put this on the platform. There are options available to trade on this. It's called MGTN, or the Magnificent 10 Index, which
Is it the
essentially,
top 10?
yeah, it's essentially kind of those Mag 7 stocks plus a few others. And it's only got data going back to October of 25. But if you're trading those sort of high flyers, the ones that have been carrying the index for so long, you're probably not in a good spot if you haven't put on hedges or taken off some of that risk. Talk to me real quick about, is that dynamic still in play? I know we're so much focused on the Middle East right now, Steph. What about the old, like the AI, the tech stocks? We've got earnings kicking off this very soon, which you almost can forget about with all of the geopolitical stuff.
Yes, I mean, I think like I've felt for a while now, like for over a year, that Mag 7, to play it all together, was no longer the play. And where you should be focused is like thinking about the world on a single stock and on a thematic basis. And the theme of Mag 7, or even Mag 10, if you want to put it that way, was over. You needed to look at those individual names on their own. So I'm not saying don't buy any of them. I'm just saying, like, don't buy the group. And I think that's mostly because, like, for example, I mean, Meta has been one that I just think got, for a period of time, overvalued. Apple's a very different story than the rest of them, right? For example, Nvidia has been on the positive side, but there is a point where, like, people start to look for other ways to get chips, right? And that competition could end up hurting it. And you actually saw, I don't know if you read, Andy Jassy, CEO of Amazon, put out a letter today that was very bullish on, obviously, their own products, which you wouldn't expect differently, but was kind of poo-pooing like NVIDIA. And so I think that's what you have to just really analyze each individual company, rather than saying like, oh, I'm going to just buy these top 10 largest names, which is why I think more opportunity will be not owning the S&P as a broad index anymore.
Interesting. And you mentioned financials, which you're about to report. Let's take a look at XLF real quick. Definitely beat up. The financial stocks have been beat up. Good stuff in the chart. Harvey Dangerous, your chart is worthless without volume. You're not wrong, sir. Mag 10 index, that's not a tradable share, so there's no volume. I'm kind of trying to keep the chart clean just for broadcast standards, so to speak. But yes, 100%. You want to be looking at volume on your chart. It helps confirm moves. It helps you understand when moves might be exhausted. So it's a very good point. Edsman, love you, bud. Good to see you. But let's before we bring in Bob, one of the companies that already announced this week, your airline carrier of choice.
It is.
But really a tie into what's happening with fuel costs and the spike in oil, and that was Delta. Talk to us about what Delta had to say, and did you glean anything from the report in terms of, how higher fuel costs might start moving into higher prices? And we're already seeing it with extra bag fee costs and other things that the airlines are tacking on.
Yeah, I mean, they had good earnings, and I do think they got a little lucky to report on the day that they did, where it was sort of like an everything rally, but they missed their guidance, and they said they didn't really want to talk about too much more in the future. And the guidance was because of the higher fuel costs. And I think, the market looked through it, stock rallied, but I don't think it's like because they're saying, oh, demand hasn't gone away. But we do still have a lot of people in this country who aren't doing as well. And gas prices at the pump are up at least $1. That you start to feel that. And so I do, maybe Delta, because they do focus on an upper echelon type of consumer, that they'll be fine. But I don't think it's the last company that you're going to see where they start to talk about the impact of not only a lack of supply from different commodities and what that means for prices, but also you do have the demand for energy hasn't gone away from AI. And so I think like you now have this other aspect to the prices. And so I don't think you're going to see as low, for example, fuel costs as we've had. And there's one chart I just want to pull up as we bring in Bob here. This is about to go into my Investors Guild, which I publish like weekly, just a piece on different topics. And just to kind of put it in perspective, like the Gulf, how much of different commodities were produced out of the Gulf relative to the world. And you can see like helium and fertilizers, they produced about 1/3 to the world. And that does mean a big deal for not only things like, helium is used in MRIs, like it's used in chip making. Fertilizer obviously is used in the world's food supply. And I know this has been talked about a lot on X, but I just wanted to kind of level set as we get into discussion with Bob. And then, of course, oil and liquid natural gas, that was served around 20% of the world. And then aluminum, which is actually a place that we've been playing in Robinhood strategies. And actually, Alcoa was upgraded today, I think, by one of the analysts. So it's an important point, and not only because, as I said, the lower supply in the world, but also demand hasn't really gone away to kind of offset that. So should we bring in the main man?
Yeah, let's do that. Before we do, once again, everyone in the chat, welcome. If you're new, get your questions in. Just a few things I want to point out. We can't talk hood stock, unfortunately, just because we work for the company and there's a lot of compliance stuff with that. We're going to avoid questions on the new Trump accounts as well as the Robinhood Ventures funds. We're just going to point you to the public communications that we put out on that. There will be plenty of more content coming from our social team and Vlad and Shiv and everyone on Robinhood Ventures. If you have questions about the markets, trading, general questions about education around futures, options, stocks, technical analysis, get them in. We'll try to answer them all before we are off air today. But with that, Steph, let's bring in the main event. Let's welcome in our friend Bob Iaccino, co-founder, Path Trading Partners, co-host of the Futures Edge podcast, which you should definitely check out. Bob, thanks for taking the time. Last time we talked, we were in Vegas at Hood Summit. Crazy times since then. Just off the bat, where are you at on this current market environment? What do you think of the 2-week pause? Is this just sort of kicking the can down the road for a couple weeks, or do you think the high's in for oil for the year?
Well, before I ramble, can I talk hood stock? I can't, right? Okay. I think the high is in for crude oil on the year, but I think we're going to have a high average for the next, let's just use the time period that everybody who's on TV says 8 to 12 months, right? Somewhere in that range. Now, I'm not really that afraid of that. If you go back in time, there's about a 43-month period between 2011 and 2014 where the average price of WTI was $95. And if you look at the economy's performance, I'm talking strictly US, you had an average GDP of a little over 2%, 2.5% or so on real GDP, closer to 4% on nominal GDP. And you had inflation right around 2.1% average over those 4 years. Now, having said that, one of the real creepy things in my view for the economy is the problem of diesel fuel and where the crude oil is coming from that's stuck. You normally have, you mentioned earlier in the conversation, is the strait really open? I think Steph said that. Well, it's clearly not. We had about, according to tanker trackers, about 6 or 7 ships go through, averages about 138 a day for the strait. So that's hardly open, right? That's like me eating one piece of pizza when I would normally eat the whole pizza.
I'm with you.
So it's not open yet. That doesn't mean it isn't going to be open in the next couple of days, but even if it is, there's a lag time before things normalize, and that's if the 2-week ceasefire extends past 2 weeks. So we're going to have elevated crude prices, but what you're seeing is diesel prices outpace. And that's because the heavy sour crude that comes out of the Strait, Middle Eastern Brent crude oil, produces quite a bit more volume of diesel than the light sweet that we produce here in the US and here on this particular side of the ocean. So you're getting diesel fuel outpacing, and diesel fuel is what I worry about, Steph. I don't know if you're worried about that, because diesel fuel is what can actually get into core inflation, because it's shipping, it's trucking,
Right.
it's
Yeah.
trains, it's travel, right?
Yeah,
Yeah. Can I ask you something about what you said earlier when you mentioned GDP?
Yeah.
We had elevated prices, and I do remember that. And I remember when oil tanked in 2014, and
Yeah.
I had some clients that were like, "Oh, let me buy it," which was not necessarily the right thing to do
No.
right then. But the interest rate environment was really different then, because we
Much
had
different.
quantitative easing
Right.
and just tons of like money flowing at the time.
Yeah.
So do you think like this time it is different for that reason?
It's very much different. I mean, a lot of things are different. You didn't have defensive stocks like Walmart with
Right.
a 48 QE on it, right? I mean, you look at the price to earnings ratio of something traditionally defensive like Caterpillar, it's at 38. So a lot of things are different right now. I just wanted to point out that the economy can be okay with higher energy prices, but things have to happen. I was
Right.
particularly concerned, I don't know if you guys were, when Cleveland President Beth Hammock said the next move might be a hike. I'm not sure how a hike could get oil out of the strait.
No.
Um, it just seemed counterproductive to me. And I really do think she was talking about, sure, I could see it happening,
Right.
in the same way that I was talking about, the economy possibly being okay, but a lot of other things have to happen.
Right. Yeah. I actually think like supply side inflation is very hard for the Fed to
It's
fight. And so
brutal.
for them to try to do something, I just think they might just like F around and you know what they say. But I want to ask you also about like the curve. The curve is like something that, and I don't know if
Yep.
our listeners already know about all this stuff, but the oil curve, right? Like oil isn't just one price; it's many prices across different contract dates, and the curve right now is in backwardation, right? Which
Yep.
means that the front month contract is higher price than the further out
Right.
contracts. And is that and that hadn't changed through this conflict. Does that tell you like, oh, everyone thinks it's going to be fine? Like all the traders think it's going to be fine? Like how should
Yes.
we watch that?
It does. And I mean, look, this is a real surface thing for me. I look at the curve to see if I should be worried about the future, see if the market is worried about the future. The obvious thing people should understand about the crude oil curve is if you're looking at, the front month contract, which I believe is still April, and you're looking out April a year from now, there's storage costs involved in that crude. So there's extra cost to holding that crude. So what we really look at as active traders is the market pushing as much crude forward, or are they okay holding on to it and paying those storage fees because prices may be better later? Right now, you're looking at a market that thinks this will be somewhat temporary, but the backwardation has crept a little tighter lately. So the market is starting to get worried. When we looked at the sell-off we got yesterday, we're obviously rallying today, and I'm talking about crude oil. There's a lot of volume in it. One of the problems, I spent about 4 years working at an actual physical oil company doing strategy for them. And one of the things we always talked about was the hedgers were in and out in the morning and they didn't really touch things. And outside of that, you were looking at a lot of speculation and maybe some larger hedging from maybe airlines and things like that. But the actual physical oil hedgers, they're basically the first hour and a half to 2 hours of trading. They're in there. And that was part of my job at the time. And that's when I was in there. So what we saw yesterday with the sell off was quite a bit of profit taking, I think. And now we're seeing this new sort of range start to establish, save anything else happening, which is a very weak comment to make.
Yeah, and just to highlight what we're talking about here, so I've added sort of the futures curve to my watch list if we want to bring this up, guys. If you're new to futures and trading futures, even if you don't have approval for them or don't want to trade them, I think it's very important to have certain futures contracts on your watch list every day.
Agreed.
Market indices, oil, gold, interest rate futures, all of that. But I've added essentially the symbol for oil is /CL. If you just type that into your Robinhood app, Robinhood Legend, it's going to bring up the current active contract, which is the April contract, I believe, or are we on to May now? Probably.
It's May, yeah.
Yep.
I was wrong. It's May.
So you can see the May contract trading 101.18, CLM, which is the June contract, trading 91.63, CLN, which is July 86.05, and then Q August trading 81.87. So the future price of oil gets lower and lower each month, and that's what Steph and Bob are talking about when they say backwardation. If it was in a contango where you had cheaper prices up front and more expensive prices out in time, Bob, that's kind of the normal way you would see
Yeah.
a crude market. Because to your point, you have storage costs, you have delivery
Right.
costs, insurance costs, and I guess one of the questions Steph and I were talking about when we talk about physical oil versus futures
I
market.
was just going to ask, yeah.
should retail investors
Should we
care as
care
much about that? Or
I
like
see it all over Twitter, like no one's paying attention to the physical market. And I don't know if it comes back to the diesel, discussion that we had.
Yeah, I think when they're talking about the physical market, they are talking about the problem with diesel. But again, diesel is a matter of the type of crude
Yeah.
that's having supply side problems, as Steph called it. You have to worry. This is why when you hear politicians say, and I'm not going to make any political statements, I promise you guys, your stomachs probably just dropped. But when you see politicians say we're energy independent with crude oil, or we want to be energy independent, that's a bit of a myth because we need different types of crude oil and we produce virtually one type. There's some mix in there, and the Middle East is also not energy independent because they need our light sweet crude as much as we need their heavy sour. You get some heavy sour out of South America, out of Mexico. You get some mix of heavy and light out of Canada. So all the different kinds of crude oils, they're not exactly fungible. From the
And I know the
perspective of,
Venezuelan is very, very thick, right? Like
yeah,
that oil
absolutely.
is like the most thick. Yeah.
Yeah, and it takes a lot of processing. That's
Mhm.
why our crude oil is much more valuable, and there's a lot more of it globally. The price is lower, but that's because of the supply of it. But it's much easier to refine. But you get much less diesel out of light crude oil than you get out of heavy. And diesel is the fuel that moves the economy from jet fuel to fuel for ships, fuel for trains, fuel for delivery trucks. It drives the economy. It's sort of like the Teamster fuel, for lack of a better phrase. But I don't really think you're missing things on spot because spot can change the second the situation changes. The future is, to me, always the more important thing. Even when we're trading stocks, we're trading the future earnings of a stock. And I think when we're trading crude oil, we're trading what the future price is going to be. If I'm going to trade what the price is right now, I have to know what's happening in the next 5 to 10 minutes. So that's not something that I really pay attention to as an active investor.
Yeah, I've had a few people during this, like every market sort of emergency, your friends and relatives come out of the woodwork and start asking you questions.
Yeah,
Oil's the new one, and I'm like, you know what? Just watch Landman. It'll give you it'll
it
give you just like
really does.
it
I
like
mean,
Wait,
it
what's
really
Landman?
does.
What is
it's
that?
Landman.
it's Taylor Sheridan's show with I'm blanking on his name. I don't know, Billy Bob
Billy
Thornton.
Bob Thornton. Yeah.
Oh,
He's
okay.
a landman that works for an oil servicing company, and it takes place down in Texas in the Permian Basin, which is where most of the oil is drilled down in Texas, and it gives you like a really good education on how the oil industry works. Amidst all the other Taylor Sheridan writing tactics, I won't go down that rabbit hole. But um, speaking of, if you're new to this market, Bob, there's a
Yeah.
lot of ways you can trade oil. There's ETFs, futures. You can go directly and trade the oil company or service companies. But there's sort of gives and take, pros and cons, perils, pitfalls of everything. If a new trader is just like, oil's volatile, I want to trade it, what are some of the things they need to be aware of if they choose any one of those given paths?
Well, first of all, I think the most popular ETF for oil is USO. We just actually had the CEO of the company that created USO on our podcast. And one of the things people forget about ETFs is there are expenses. They're
Mhm.
minimal, right? They're tiny. If you have a 35,000, I'm sorry, a $1,000 investment in USO in a year, you might pay $35 of fees on it. So it's not a crazy amount of money. But to me, crude oil futures is what you need to pay attention to learn the movement of crude oil. I don't recommend anybody go in to trade it until they've tested their strategy against it, until they learn some of the characteristics. For example, crude oil is one of the most pure supply and demand markets, in my view. A lot of commodities are like that, but crude oil is kind of out in the open. For example, there's about 40,000 tons of copper going through the Strait of Hormuz every day. People don't know that. So they don't think of how the strait is affecting copper. They only think of how the strait is affecting crude oil. Micro crude oil futures is the best place to start because this does move. And there are some differences. For example, don't quote me on the year. It was either 2008 or 2009. Crude oil futures ended the year 48% higher, and USO ended the year about 18.7% higher because USO has a strict roll policy and they weren't rolling at the optimal time where futures are shifting to the front month when the volume made basically forced them to shift to the front month. So there were some differences there. So I think I always say this when I speak, and I'm actually speaking tomorrow on the other side of my state here about this exact subject, is that the only thing that's correlated to crude oil is crude oil. So if you have an opinion on crude oil, the 100% correlated product is crude oil. But the ETFs are sometimes a milder way to trade it. They seem smaller, but I prefer personally when I talk to people that they take very small positions in micro crude if they're going to start trading crude oil.
And I
Yeah.
guess another way to play it too is to buy like energy stocks, right? But then what you get in the mix there is not just the commodity, but also like operational decisions
Right.
and interest, like probably more so interest rates, although interest rates have an impact on the prices of oil
Yeah,
as
I
well.
had a slide years ago, Steph, and I don't remember what year, and I don't want to say what company because it's old news, but an energy stock actually was down about 7, 8% on a day where crude oil was up 4 because there was a rumored CEO scandal. So
Yeah,
I just, that's why I always feel like when I used to
yeah,
do CNBC all the time, they used to say to me, "So oil is up, what names are you looking at?" And I'd reply oil, and I would look at the
right.
screen. So I'm looking at oil. That's probably why they stopped having me on.
I wanted to switch a little bit because commodities broadly has been now turned like everyone's becoming more of an expert on commodities, and I
Mhm.
spend probably more time than I should on X because I do learn a lot from people's commentary there. And one person there on X, and I can't remember who it was, so I'm sorry if if I'm stealing their thunder, but they said there was a relationship between copper and gold, and that it kind of it creates a signal for the broad economy, and probably because gold is considered like the safe thing, and copper might be more like kind of economically sort of more cyclically oriented. So they said every major S&P bottom since 2011 has been confirmed by one signal, which is the copper and gold ratio signal. They said they back tested it across various drawdowns over the last like 10 plus years, and 86% of the time the copper gold ratio bottomed the same day as the S&P, or it lagged by a few days. What are your thoughts on that? Like, is that something that you kind of watch when investing, what copper and gold are doing against each other?
So I don't look at the ratio relative to the S&P because I'm just, again, similar to what I said about crude oil. I'm a big believer of gaining an opinion fundamentally and through price charts and sticking that opinion to what I'm actually looking at. So for example, if I want to put on an S&P trade, I'm going to study the S&P chart, I'm going to study the fundamentals, and I'm going to put that trade on or not. From an investing perspective, I will leave that to longer term investors, but I could see how that would make sense. I've never back tested it, and I never worry about the day that an asset bottoms. I've been in the markets for 34 years now. Oh, God, saying that out loud. 34 years I've been doing this. I've bought the low and sold the high 4 times. So I've decided that it was easier to just let somebody else find the low and try and take a portion of the move. But I have heard that, and I do believe there's something to it because if you break it down, and you could probably do that better than me, it makes sense that if that ratio is bottoming, that's about time for either the Fed to cut rates or possibly even restart QE, which I would argue they've already done, and move things into economic growth mode as opposed to being afraid of inflation and stabilizing it. I do look at gold a lot. I don't personally own a lot of gold. And I don't believe it's an inflation hedge. I believe it's an inflation hedge when the Fed isn't fighting inflation. Because when I look back on it, that's when I see that gold responds. The minute the Fed steps in to fight the inflation, all of a sudden gold doesn't work.
Yeah, I think watching gold this year has been super interesting, but I agree with you. I've always said gold to me is not an inflation hedge; it's a disaster hedge.
Agreed.
And that's what I'm like. You hold it if you think something bad can happen. Um,
Yeah.
so I know. I guess like gold, like it was interesting though that it was going down during the conflict. And some of the rumor was that it was because, a lot of the GCC countries were buying gold. And then once their oil proceeds turned off, they couldn't buy the gold and they had to sell the oil to, kind of fund their operations. Is there any sort of what's your kind of view on gold right now?
As much as I could say what you just said is a fact, which is not, I can't say that. I'm going to speculate that that's what the fact is. And not only that, obviously the margin calls, gold had ran so far so fast. I don't know if you or I have ever seen such a parabolic move in such a quote unquote useless commodity, right? I mean, it doesn't earn a yield. It isn't really that useful in industry. It's just a disaster hedge. And it's just they're continuing to destroy the dollar hedge. So I think the speed with which it moved up made it the obvious sell if you needed to raise money for margin calls, or again, with what you said about the crude oil, and also the inability of central banks to buy gold at such extended prices. I fully believe that as this conflict winds down and markets stabilize, central banks are going to start buying gold again, which is why I haven't sold any of mine. And I also believe that we're not going to all of a sudden, and by we, I mean the US, start being real strict with the stewardship of our currency. So I still think gold has a long way as an investor. As a trade, it's doing nothing to me right now. It's held up amazingly well. I would have expected, if somebody would have described the situation to me, I would have expected gold to be down below 4,000, and it hasn't. But that's just not a reason for me to buy it. That's just a reason for me to continue to hold what I have.
I see.
Yeah, and guys, as we're talking, pointed out in the chat, S&P's starting to rally. No major news that I'm seeing, but this is that type of market where,
Yeah.
once again, you're getting 100-point swings in a day on the S&P. As a trader, you like that type of volatility. You have to be a little bit nimble and understand the whipsaws and probably not hold on a position as long as you may in typical environments. But with that, guys, let's get to the Q&A. I know we got a lot of questions piling up. The chat's been great. This is, it's a fast-moving chat, so we haven't been able to address everything in real time. We apologize for that. But let's get to our first question. Our old friend Felipe, maybe did he update his handle? It used to be just Felipe. Now Felipe updating asked Steph, thoughts on quarter-over-quarter GDP print today and factors to think about for GDP going forward?
Oh, gosh. Of course, you're asking me a question that I don't have an answer to because I have been traveling all morning. What did the GDP do? I'll let me look it up.
3.7 quarter over quarter.
Oh, wow. That's really strong.
Yeah.
But it is kind of backwards looking if you think about it. It's very kind of pre-conflict, pre-issues. So I'm not that surprised because I've been calling for a high GDP print. I think you could have a little bit of a slowdown kind of coming into this next quarter. But what it does do is support the fact that the Fed does not need to cut, nor does it need to raise rates right now, because I think they have to see how it goes. So, I don't know how helpful that was, Felipe, but I'm not sure it actually moves the market.
Yeah, Steph, I've got the prediction markets up now. If you want to look at prediction markets on web, you can do that from the old Robinhood Classic. Going out to June, Fed maintains at 90%. April, Fed maintains 98%. It doesn't look like there's any rate cuts coming anytime soon. And between the jobs data and this GDP data plus the potential inflationary, it kind of puts the Fed in a bind, no? Where are you guys at on what's the Fed going to do with all of this? We know that they kind of move slow and wait for the data, but does this change any of the calculus there?
I don't think the commodities market is going to change it right now because, like I said before, I think a supply-driven inflationary environment, the Fed is not set up to fight that. They're set up to fight a demand driven inflation environment, which this is not. The other thing, I know jobs was really strong. What was it, a week ago Friday? But then if you look at, the San Francisco Fed puts out a weather adjusted jobs report, and their numbers were much weaker. There's another person, this guy called Michael Green. He writes a blog called What the Fig, and he was pointing out that there's a metric that they use to kind of estimate what jobs will be, and I think it's the birth death adjustment or death birth adjustment, and it's not been adjusted. in a long time. And so it makes it feel like jobs should be higher than they actually are. So that is the one thing between those two data points, the fact that weather adjusted jobs they were actually down versus being up from the Bureau of Labor Statistics numbers that got put out over a week ago. So the one thing I think we have to watch is the job market. I think the Fed is going to like stay away from commodity driven inflation, like doing anything about it, and just to see if it kind of calms down over time, at least for now. But I think they're going to watch the job market pretty easily. That being said, one of the first economists that I ever worked with said that the answer to every question is inflation. So if the job market stays or like kind of just stays at least flat, then maybe they will start to care about inflation. We just have to see how the growth is.
Got it. All right, we got questions piling up, so we'll keep moving through this. I got to get this right. The Steve Caston actor asks, need a good perspective on where you think the market will head with or without the conflict in Iran. Bob, I'll start with you. Where do you think we're at in 3-6 months? Is this going to be a sideways market over the summer, or are we going to approach new highs, you think?
So I assume by market, he does mean equities. And I do think that we're poised to get back to new highs, but I don't expect for it to happen over the summer. Everything, as Steph said, is relying on commodities, and commodities are reliant upon this conflict. I don't want to say ending, but stabilizing. When you look at it from that perspective, if you take the decrease in regulations, there are stronger tax refunds coming to people. I know that anecdotally from with relatives of mine who called to say, should they fire their accountant because they're getting too much money back. That was a change in the tax code. So people are getting more money back. Some of these people, it's based on no tax on overtime, which is capped. So let's not call it that. But essentially, I think there is enough of a tailwind for stocks to get to new highs. I just don't know if they get there this summer. I'd like to see them do it before midterms, because I think midterms could sour the mood a little bit. But this conflict has to end, in my view, in the next month, or we're just going to go sideways.
Yeah. Speaking of Steph, Mr. Communities asks, what will the effect of a ceasefire actually have on the market? I think we saw some of that earlier this week. Whether or not it's going to hold, I think, is the bigger question. Where are you on how sort of this ceasefire might play out? And more importantly, are we still in sort of a wait and see moment for the market, or is the market going to potentially start discounting this and move on?
My take is that I don't think the market cares anymore about like the military aspect of it, and other commodities can start flowing, or that the market can see like the by when date that it can all start flowing again. And that's what we don't know yet. And I think the market kind of assumed, yesterday with the ceasefire announcement that there was going to be, a by when date. And I think it's a little bit muddy still. But I think the incentive to get past it is relatively high, especially in a year where we have midterm elections and there is a decent amount of consumers out there that aren't feeling as great as they were before a couple of years ago because things are more expensive. So I think there are incentives to kind of improve everyone's situations and get past it. But I also agree with Bob in that I think there'll be a limit to how far the market can move up, even with commodities starting to flow again, simply because of valuations. Like I think under the surface, you'll find interesting opportunities stock by stock. But I do think that, we're kind of feels like there's sort of a cap on the market as well.
Yeah, I guess.
Well, can I say something real quick?
Yeah, sure, Bob.
I just want to, first of all, I'm going to steal that from you, Steph, that the market doesn't care about the military side anymore, because I completely agree, but you said it better than I could because I'm an idiot. But I wanted to point out that yesterday's rally in the NASDAQ futures took us to the exact level we were before the first bombs fell. So you're seeing that almost completely wiped out, although there was a sell-off before this conflict happened for some reason. And when we started this conversation saying it's crazy markets, doing this as long as the three of us have, it seems like we're saying that once or twice every year.
Yeah.
So it's just starting to feel somewhat common.
Yeah, if we want to bring up that chart of the S&P again to highlight that level. Right now we're at 6840, but the 6800 level was a level the market kind of treaded water over the sort of formation of this topping pattern, whatever you want to call it. But here we are back at that level. You know, I think, like I said, to me as a trader, this has been there's been a lot of opportunities in this market, but nothing that lasts longer than, say, one or two trading sessions. It's
Great.
really hard to stay short when you're whipping back 50, 100 points on the S&Ps. It's really hard to try to, picking bottoms is a dumb exercise, as Bob pointed out earlier in the show. But this is why you have to understand risk management, trade sizing, stick to your routine and your methodology, and don't try to outkick your coverage, so to speak, in relation to what you're trading. Felix 1K asks, what's going on with natural gas? Why is it down? Bring up a chart of that, Bob, and set you up here. We saw a huge spike in natty gas over the winter. I think it was a relatively harsher winter than recent years. But here we are back at 266 on was that the April contract or May? What do you think about natural gas here?
So everybody looks at the EIA gas report. I would recommend you start looking at the EIA natural gas report, because if you do, what you'll see is that natural gas in the US specifically is almost always in surplus. Based on the last report, there was a big build of 36 billion cubic feet in the last report, yet we still remain 96 billion cubic feet higher in terms of storage than last year. Supplies were increased from 1,829 billion cubic feet. I know that's a trillion, but that's how they say it, to 1,865. The surpluses continue to build. There is just a massive seasonal play in natural gas. I don't recommend trading it. I've tried, I've lost, I think every single time I've tried to play the seasonals of natural gas, but it is, in my view, the most seasonal market. We have summer coming. We're going to have not much demand for natural gas. It's a good time for us to have the interruption of supplies from the Qatar field and places like that. And it's just not affecting price because we have such a surplus. We still burn off a lot of the natural gas that comes out of the ground because it's in surplus. We just don't need it.
Good point. It's a tough market, and if you're trading that gas futures, that NG contract is a big contract. You definitely want to start on the smaller size contracts. There's also UNG, which I think is the ETF that tracks natural gas. But it is a very nuanced market. Tread lightly before you trade it. Let's probably go to you as well, Bob. Woo's Hen 42 asks, would you trade the oil term structure by going along the back month, short the front month? So this is a future spread trade, basically a basis trade. It's kind of complex for a newer trader. It's more something I would say is kind of an advanced strategy. How do you look at spread trading in futures, Bob, and what do you think of the curve?
I don't do that trade, mostly because of, first of all, the back months are pretty illiquid. So you don't end up getting into the prices that you want to. If you just look at the volume of the crude oil curve, you're going from, this is approximate volume, about 174,000 contracts in the May right now, about 351 in the August. It's just illiquid. And you also don't have, it's not required that the two prices converge.
Yes.
You sometimes, not all that often, but sometimes have large gaps on the roll. So it may work, it may not. It's just not something I've ever had much success with.
Yeah, the front month can get more expensive and the back month can get cheaper. There's no reason why, to your point, they have to come together.
They don't have to converge. I think that's the key.
Yeah, and there's some margin relief with that type of trade, which is one of the reasons people look at it. But it's definitely one you got to be. I would personally practice trade that over time and kind of get used to the mechanics, because you're not looking at single prices anymore. You're looking at differences between the two prices, and it kind of takes your brain for a spin.
What would you have to believe to do that trade? Would you have to believe that the front month was coming down, or what would you have to believe for that?
You would have to believe in the difference in speed of the movement, right? Because if you would make no money if they moved exactly together every time, right? The price would be the same. So you would have to believe that one was going to go down and the other was going to go up, so that you could cover it at a smaller price if you were short the spread. I forget which way he had the spread in the question, but you would have to believe that one was going to move faster than the other. And that's the problem with the low volume in the back months, is they often don't move very quickly.
Right.
Yeah, and I do want to point something out. It doesn't fit in with this scenario, but go back to COVID when the world was shutting down and tankers were piling up, and people were like, "Oh, I'll buy oil at $5 a barrel. It can only go to zero." Not true. Bob, I saw a documentary that you were in about
Yeah.
that, which was funny. I saw your face. I was like, "Whoa, Bob got in that." Oil went to negative. Oil commodities can go negative. Just remember that.
They kept trying to get me to say that, to say why I didn't buy it. And the reason was why I didn't buy it is because I was scared to death of it. I didn't want to
Good
hold
enough
oil.
reason.
I didn't want to get delivery of barrels of oil and hold. Anyway, it's a
Yeah.
whole nother
Yeah,
conversation.
do a YouTube search with Bob and oil, and there's a really cool documentary, and it's kind of interesting. Our good friend Edsman Archery, which by the way, Edsman's Steph says that color looks great on you.
Oh, thanks.
Fantastic. Edsman, who's our number one fan, we met out in Hood Summit. Hope you're doing well, sir. Steph, with the elections coming up, do we expect a usual downturn, and will it be after the market recovers from the war? A couple questions mixed in here. What do you think about us going into the midterms, and how's the market going to start pushing through into the fall here?
I feel like we're experiencing that typical downturn now. It maybe just be exacerbated by the war and this, commodity issue. I do expect, I kind of expected has already happened, but we have to really see what happens with the commodities market.
Everyone in the chat saying we have no sound, guys.
Oh no.
Yeah, we hear you. Can we double check? Yeah, everyone's saying the show's
Yes.
muted. Hold on. Put me on camera.
I muted?
It's
Good.
back.
Okay.
All right, we're
Can we
back.
just say
We're
that
back.
every question in part,
Can you
every
guys hear
single
us? Here we
question in
go.
part?
Like I said, we haven't been on live stream since November. The Studio Gremlins hideout. Recap the last part of your answer there,
gosh.
Steph.
I don't remember what I said. I think I said, I think right now we're going through the typical downturn that happens before midterms. But I also feel like I'm a broken record in saying that we really have to focus on what happens with the commodities market. And I do think there is some incentive from the administration. I had this view of a theme called, I called Keep the Customer Happy. And I thought they might do something for the housing market. It hasn't happened. And, that may not happen. But I think everything goes back to the commodities market. And the midterms feel a little bit like it may not be as important this time around, just given everything else that's going on.
Yeah, we'll see. It's going to be an interesting midterms. We're seeing a lot of the special elections do some crazy things, and I think the market's pretty good at handling political change as long as they can sort of price in what's going to happen, right? If it's a split Congress, that's usually good for the markets. Meanwhile, Edsman, thanks for the question. I saw you did ask about my honeymoon. For those that don't know, I went to Hawaii for my honeymoon, and Edsman lives out in Hawaii, and he helped me with the planning. It was great, man. We did all the stuff you did. We did the road to Hana. We surfed, played golf at the Kapalua Plantation course. It was like the best round of golf in my life. So appreciate the help, bud. Hawaii is beautiful, and mahalo, my friend. Last question, I believe. The Jake Hands asks, what is the likelihood the chip artificial intelligence bubble has actually already burst, and do you believe tech stocks are trading at fair value? I'll start with you, Steph, and Bob, if you have any comments on the end of hers.
I think the big tech names are still a little overvalued. I think they came into the year overvalued, and you've seen a lot of them fall in value depending on the name. Um, that being said, a name like Microsoft is, down a lot more than a name like Amazon. So, you've seen the differentiation in there. I I don't think we're I think we also saw like a pullback in some of the power names, for example, that like would a name like Vistra or CEG, Constellation Energy, I should say, because I do think like those got a little overvalued and caught up in the AI trade. So I do think it's like stock specific. The rally that we've been seeing more recently in the AI trade has not been like in the chip market, but more in like the optical market, and those have continued to run despite what's been happening more broadly, like geopolitically. And so I think anytime something's up a lot, you just want to kind of check yourself and be like, do I really like, if you're in the trade, like I said, make sure you're trimming your winners at least a little bit. So I think the overall, like the AI trade is not like one thing. There's like pieces of it, and it kind of moves through. I do believe that the biggest hindrance to the AI trade is going to be the access to enough power relative to power for just powering us as humans. So we do have a lot of natural gas, as Bob said, but I think that's going to be a little bit of a fight. And you may also have been reading about the environmental impact of all the data centers that are being built. So, you may start to see some because of those things, you may see temporary slowdowns in those trades. And that's why I think this is the year for diversity, or not just this year, but like, I think diversification is an overused term, but I think this year it's actually going to be helpful.
Final comments, Bob? What do you think?
Yeah, I think I mostly agree with what Stephanie said. I don't think that a 13% drop in the S&P, I'm sorry, in the NASDAQ is a bubble bursting. I think it's a bubble leaking. And I think it is very stock specific. When you look at, for example, the 10-year historical valuation of the Qs, for example, or the P ratio, it's closer to 26. We're a lot higher than that. That doesn't mean that the mean PE couldn't move up over time. But I think when you're looking at AI stocks that have valuations in the 3 digits, I'm not going to say it's a bubble, and I'm not going to say it's a bubble that burst. I think it's very stock specific. I think at some point there's going to be a long period of sideways, and we may have started it now, sideways movement in AI stocks as the winners and losers get vetted. They're all going to go sideways. And something that people forget is you can have a sideways correction. We've had a couple in gold lately. So I think the sideways movement of these stocks, where people are going to sit and remember the sort of Cisco's in the world that took 20 years to get back to their all-time highs, 30 years to get back to their all-time highs from when they fell in the 2000 crash. No, I don't think it's fully burst. I think it's leaking, but it hasn't burst, if there's a bubble at all.
Excellent. Well, with that, once again, the chat, just some great comments I'm seeing here. Steph requesting that we're on here weekly or daily. We've had that idea.
I don't know about daily, but definitely we can maybe figure out weekly.
Let's just say we're working on some stuff.
Yeah.
Hopefully we can get some stuff out to you guys soon, and maybe we'll do more of these as the market continues to sort of maintain its volatility. But before we say goodbye, I have to have a little fun. I'm wearing my Masters green, first day of the Masters tournament, my favorite 4 days of the year. We got prediction markets on this, guys, and we're just going to take a look. I don't know. I know that the guys are teeing off. Steph's going to kill me for doing this, but let's bring up the prediction market guys on the Masters. Right now, Scotty Scheffler trading 14 cents. Tommy Fleetwood, 11. Rahm, 7.9. Reed. You guys got any horses in this race? Any
I like
mess?
Fleetwood. I just like his name.
Tommy Fleetwood. Awesome. I'm a Rory guy. Hopefully it'd be amazing to see him win back-to-back, but I doubt it. that's it for this. We'll wrap things up for the special market update. Like we said, who knows? We might do this again soon. Keep an eye on your notifications. Subscribe to the channel so you're notified when we go live. We've been doing some video content on prediction markets. Check that out. Thanks for everyone for watching, participating in the chat. We miss all of our regulars. We love you guys. Don't forget, follow Steph on X and Instagram at Steph Guild NYC. Look for Bob Iaccino on socials and all the other places you can find him. What was the name of your podcast, Bob?
It's Futures Edge Finance Unfiltered.
Beautiful. Check that out. For Steph Guild and Bob Iaccino, I'm Michael Obucina. That was the market update. Happy trading.